All right, guys, we're going to do another market update video here, but this time we're going to be focusing on the growth to value spread, the massive amount of cash that is now on the sidelines, and how even though we've rallied about 30 plus percent from the bottom, it looks like we may have more to go. And I know in the last video I was talking about how hopefully what we would do from here is go down and consolidate, really build a foundation that we'd be able to launch the next two, three, four innings of the bull market off of. But I want to play devil's advocate here for a second. And I want to also approach this as well. What if this was very similar to December 2018 and January, February 2019? What if, this is the exact same opportunity we've had a couple other times and how we'd be able to take advantage of it, but also how we could kind of spot the risks of it. And so last time we had talked a little bit about a couple of the signals like this, right? So this is the AII sentiment survey. The whole idea behind this is getting a gauge of what people think about the market in terms of if it's going to be up or if it's going to be down over the next 6 months. And the members of this sentiment survey, dating back to 1987, are at an extremely low percentage of bulls, which means that the majority of people feel that we're not going to be going higher in the next 6 months. So that really plays into, you use this as kind of a contrarian indicator in a way. And you look at this, and then you look at this, which this is the cash on hand. So this is fund managers, how much average cash balance they have. And we've used this chart in the past. And we had compared, I believe, in 2019, we were looking at how high it was then, right? And we said, well, the market's not going to go down with that much cash on the sideline. And the reason is simple supply demand dynamic, right? So if there's tons of cash on the sidelines, that means there's a lot of buyers on the sideline. All the sellers have already sold, generated all the cash, and now they've turned into buyers. It's only a matter of time until they choose when to get back into the market. So we're currently at levels of cash as far as the cash balance for these fund managers dating back to 2001. I want to make a, this, a lot of times the media will make comparisons because they have to, because they're looking for reference. And so they're going to compare what's happening now to 08, 09. They're going to compare it to 2000, 2001. They're going to compare it to 87, 1929, 1906, 1907. They're going to make all those comparisons. But what you really need to understand is that each of these is extremely unique on their own. And what I mean by these is that, these corrections in the market, when you get a 35% correction, that is extremely unique. That is not something that happens often in the stock market. And when it does happen, we're looking for ways to relate it back to what has happened. And when the whole basis of doing that is just so, hey, what can we expect going forward? Is there something we can expect going forward? And so when kind of analyzing the market, you have to kind of take those kind of polar opposite ideas, which is this is like nothing that's ever happened before, and also saying, hey, there should be some historical reference for this dating back to the beginning of the markets. So when we look at this is obviously different from 08, 09. And what's really interesting about this, though, is that it does bear some resemblance to what happened in 2001, 2001, and in some ways even to 08, 09. But just because it bears resemblance does not mean that it is in any way similar. So the one thing I want to point out to start is markets can't go down with this much cash. And what I mean by can't go down is I mean they can't crash with this much cash on the sidelines. People have already liquidated their positions in March and April. There's a ton of cash right now. So you're not going to get a crash. Can the market go down? Yes. Can the market crash again? I do not believe so, unless something catastrophic happens that the market hasn't already priced in. So another thing you want to look at, and this kind of makes a lot of sense, is first off they went into defensives, but then also they went into healthcare. Now that's like obvious, right? Because you're going to play for the biotech plays, the medical supplier plays that are going to help these hospitals, help these physicians, kind of supply the pandemic, right? They're gonna make sure that the hospitals and the physicians have exactly what they need to kind of fight the coronavirus. So cash and healthcare make a lot of sense. Utilities, we've talked about that. Maybe even too much. Utilities and REITs, in my opinion, they were the yield play that got a little out of hand, and we've talked about some of the names. And I still believe this is the case, but just look at that. Back in 2019, we were talking about this thing getting a little too jumpy. It had came down in December of 2019, makes a new high in February of 2020. And then from there, just like many of the other things, it just got absolutely whacked to the tune of about 45%. Now, this is just one of the examples. This is Sun Communities, which is a REIT. But if you want to look at the REITs, I believe it's XLRE. That's the spider. So again, bears resemblance to the stock. And you can see, again, you took a 35% haircut there. That kind of happened across many of the sectors, some more than others. But, these yield plays, like I said, a utility, if it was just doing this, just kind of going up this nice 45-degree angle nice and slowly, that's fine. But you can see as it kind of gets away from that trend, I mean, these are utilities, ladies and gentlemen. They supply us with our lights, they supply us with our gas, they supply us with our water. They don't cure cancer. They should not be going parabolic like that. They're a great value play when you're looking for yield, but only at the right price, in my opinion. And you shouldn't have to pay up like this. You shouldn't have to pay up this much to get that yield. And you could say the same thing for bonds, right? So when bond prices go really high, you shouldn't have to pay that much to get the tiny yield that's currently out there in the bond market. Oh, that's actually the notes. What's the is it ZX? What's the 10-year? Notes. Where's the yield? Notes. Yield. There we go. So you shouldn't have to pay up that much for a tiny yield, right? So kind of the same thing when you look at utilities and REITs. So you have a ton of cash on the sideline again. We're back to where we've almost always been, and it's been this way for actually quite a while. Equities has made a big jump down, where equities, I think, was kind of middle of the road to high as far as where they would put their positioning. Energy has always been a laggard. And let's talk a little bit about energy real quick, about the dynamic that has changed with energy. Back in 2019 in August, we were really thinking, hey, look, this is, these companies pay a high dividend. These companies are being, poorly valued. Growth is running away with it again. Growth is being overvalued. If you could get these companies at these prices and get some yield, they're a great play. Well, obviously now that wasn't such a great idea, but what it took was it took a pandemic, and it took Russia and Saudi Arabia to oversupply the market for these companies to crash. But let's really talk about what that does on the demand side going forward. When you have companies that are starting to consider taking their workforce and going 50%, 75% remote, no longer needing these massive office buildings, no longer needing the energy to run those buildings. No longer are people fueling up to commute 1, 2, 3 hours a day round trip to get to that office building. You're completely changing the demand side of the energy space. And so if your demand side is going to be permanently lowered going forward, then energy is not a good play, right? Because you would need high demand for prices to rise. There's no chance whatsoever supply is going to go down. So you're going to get all these production cuts that you hear on the news, but in actuality, you have to understand that there is always going to be more supply of oil than need, especially if we start going to solar and we start going to nuclear and we start doing more wind. So the demand for oil, for carbon energy, is going to go way down. And so because of that, it completely changes everything. So what this pandemic did is it kind of sped up that process, where before you were saying, okay, we're probably going to have another 10, 20 years of really 100% relying on oil and gas to supply, obviously for all the transportation and things that we use it for. But now, if the dynamic changes, if the new ceiling for energy is much lower now, it's going to completely change how we can even price a lot of the energy stocks. So when you look at like the Exxon Mobils of the world, and let's run this back a little bit, saying, oh man, you know, you're looking at ExxonMobil down here at 35 to 38, at 35 to 40, right? That's where it was for a little while. You say, oh man, what a great value. It was a really good value at 60 to 70, really. But it was an unbelievable value back here. But I would say, and I even thought that at one point. But what I would say is, like, hold your horses here a bit. Do we even know how energy consumption is going to be going forward? When companies are starting to say, wow, we can be just as productive with our employees at home and we don't have to have the overhead of the office. And now the employees are like, whoa, you're telling me I don't need to spend 20, 30, 40 bucks a week on gas? That just changes the dynamic completely. So a lot of these companies where it's like, oh man, uh, great dividends, low prices, buy low, sell high. It's now, when before it was like, whoa, this is a great idea. Ever since the coronavirus, it completely changed how you can value these companies going forward. So what I would say is, and before I was thinking of putting a solid piece of my personal portfolio, but also clients' portfolios into energy, because I said, wow, this is a complete store of value right now, like just completely mispriced stocks and sector. But now I really have to look at it and say to myself, whoa, 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 you can't look at it like that, because the landscape has changed, the environment has completely changed, and even at these prices, you can't you have to see the risk of it, and the risk, I think, is pretty high even at these levels. Does that mean that these stocks can't go up 100% from here? No, that's not what that means. What it means is this higher risk going forward. So that means, in my opinion, that if you were to buy at these prices, it's going to take you a lot longer to make some money in them. But also, there's, where before I was like, man, there can't be much risk to downside here. Well, I think the risk to downside has increased. So even at these levels, so you got to take that into account. So now when I'm looking at value, I'm sticking to infrastructure, I'm sticking to materials. If they're going to pump free money into the economy, if they're going to pump free money into everywhere, into globally, and we're going to build some infrastructure and we're going to do some things that's actually going to help our country, uh, then I think the material plays and the infrastructure plays are going to be great. It's some of the transportation plays too. When you think of railroads, you think of like the FedExes, and so those are what I'm going to be looking at for value. I'd still consider some energy, especially ExxonMobil. You're talking about a company who's paid a dividend for 37 plus years, and they've grown their dividend for just as long, I believe. So I wouldn't be overly afraid of Exxon here, but still, when the environment and the landscape changes, 2020 is not like 1990. It's not like 2000. We're in a totally different environment. If people didn't have the option of working from home in 1990, they didn't really have the option of working from home in 2000. But in 2020, having the option to work from home completely changes the energy landscape, just completely. So that was my energy rant. Hope you enjoyed it. So one of the other thing, I think we had talked about this briefly, but people are really looking for a U-shaped rally. And when we talk about how markets come out of these bottoms, we look back into 1987. We're going to call this kind of like an L bottom. Okay. Let's see if this. So that's kind of like an L bottom, right? Comes down, forms an L, just kind of drags it out for a really long time. When you think about a U bottom, you could kind of think of the 2002, 2003. That's more of a U bottom. You can even call it maybe like a W bottom. And so where was that? So, U bottoms, W bottoms. So people are thinking, hey, the idea of a U or a W bottom is we're going to retest the lows, or we're going to stay down at the lows a little bit longer. What's really happening in actuality right now is that we're catching ourselves a V-shaped rally. And like I had said in the prior video last week, I hope that isn't the case, because the market's going to be tougher to analyze if that were to happen. And that's mainly because of this growth value dynamic that we're going to be talking about in a little bit. But if this thing just rallies back to the highs, it's going to be really tough to find value in this market. You have companies like freaking Wayfair leading. Like, look at that. Now, one, that was a lot of short interest that kind of catapulted that stock. But you're looking at Shop, which now Shop is an extremely valuable company, in my opinion. It allows small businesses, small business owners, online e-commerce stores to transact online. And going forward, that is how we're going to be doing things. Brick and mortar will at some point become just warehouses in the future. But for now, again, you ask yourself, is this overvalued at this moment? And I believe it is. And you can look at this similarly to the Microsofts of the world. You can look at this like Apple. If you're thinking, all right, what's the next Apple? What's the next Microsoft? Shopify is going to be a part of our lives, most likely for the rest of our lives. And so I put it in that same basket of stock. But again, as far as the valuation is concerned, I think the PE on this thing, let's see what the PE is. It's probably out of control. Forward PE of 1,330. So I think you understand, right? So actual PE, 0, because it doesn't make money. Forward PE, this is like the anticipated money it's going to make. It's still going to be way overvalued for the money it's going to make. Listen, I'm not saying this isn't a good company. What I'm saying is the value of it at this current moment is out of control. 84.73 billion market cap. Yeah, no, thank you. That's not a company I can invest in. And hopefully through these videos, that's not a company you can invest in at these current prices. So, but these are the stocks that are kind of carrying us. They really are. So you look at like more software, Salesforce.com, getting close to the highs again. You look at Coupa Software, almost. I think last week, was it last week? Yeah, last week, new all-time highs. Look at that. Team, Atlassian Corporation, that hit new all-time highs last week. Can't wait to short these things. Not Gilead. I don't know why I always go to Gilead. What's the other one? Viva. Okay, new all-time highs. So software got mangled and then just came all the way back, no problem. So these are the companies that are leading us higher, and you can look at that just by looking at the indexes, the difference between the indexes. This is the NASDAQ. So NASDAQ, tech heavy, making a huge bounce off the low. Huge bounce. 38% off the lows, it came down just as much, maybe just even a little less than everything else. So you can say it held up better than the Dow, than the S&P. If you were to compare this to, let's just throw the IWM up there, which is small caps. Look at that. Look at the difference. So tech is leading us right now. And going into the summer, I do not believe tech is going to be leading. I think tech is going to be lagging. So again, and that's what I hope. But again, when you look at how much cash is on the sideline, when you look at the interest, where is the other thing that I had up here? Did I pull it over here? Yes, I did. Oh, you know what I did? When you look at the amount of interest that's happening right now, so retail traders are trading like crazy, more than they've ever traded in the past during any of the other corrections. And if you really look at this, this is trending higher. So, what are these people getting into? Well, they're getting into the things that are in the headlines. So, you got your FANG stocks, you got Facebook, Apple, Amazon, Netflix, Google, all in the headlines every single day because that's what gets the clicks. And these are the things that are leading the market higher. And if you've been in the market long enough and if you've got washed out enough times, you know that that's not a good thing. So what I mean by that is that at some point, these people are buying things that they have no idea what the actual value is. So they're piling into Shopify, they're piling into Wayfair, and they have no idea what the actual value of those companies are. Now, look, I'll play devil's advocate with myself all day. Like, hey, make some money while it's going up. You know, there's no shame. There's no shame in trading this, right? There's no shame in catching these big moves that will make you. I mean, look at how many points this thing's moved since the bottom. Since April 2nd, this thing's up 117% in a month. It's up 117% in a month and a few days. So yeah, I get it. Like, great trading vehicle, excellent trading vehicle. But when you're investing in things for 5 to 10 years, a month isn't going to make or break your portfolio. And so that's something you really need to understand, is that this isn't investable, in my opinion. Is it tradable? All day long, twice on Monday. But no, it is not investable at these prices. Unless your time horizon is, I mean, for me, 33 years old, I have another 30 plus years of investing left in me. So yeah, maybe I could invest at 700, tuck it away. I'll probably lose 50% of it at some point, but then hey, it'll probably double or triple by the time, 45, 50. But why? You're losing by investing in this, by sinking a piece of your portfolio into this, you're losing out on the opportunity that's in the market. And now we haven't even looked at financials a lot. And normally what they say is financials don't do well in a low interest environment. But again, these companies aren't going anywhere. Oh my God, that was sick. I sometimes these financial stocks, I forget how high they were um, back then. But these companies, like Kyle, why in God's name would I get into Citigroup when I could get into Shopify and make 100% in a month? Well, the reason is that you're investing over the long term. You're not investing over a month. Um, so the other things I wanted you to just take a look at. So again, they went to defensives, tons of cash, completely. They are as underweight equities as they've ever been. And just when this much cash is on the sideline, you cannot rule out that this thing grinds higher, that it just keeps going. Even if it went sideways or something, right, for the next 3, 4, 5 months, that sideways movement would suffice to kind of grind the rest of the people out, create some value, and then take off. That would be fine. I was really hoping that it would just stay down. So we're gonna see. We're gonna see what happens. There's still a lot of valuable stuff out there, and the next video I'll do next weekend, I'll talk about specifics. Really looking to baskets of stocks like I did a few weeks back or like a month back. Um, so we'll look into some stocks next week. And again, I just want you all to kind of realize where we're at with this market. It's been an incredible run in the Nasdaq. It's like just as shocking as this move down has been, this move up has been just as shocking in my opinion. Uh, how the market's being carried by the Nasdaq right now is pretty incredible. But again, I don't think that lasts just because a lot of the tech stocks that are kind of grinding this thing higher are just so overvalued. And if those things even come into their mean, if we just get like a mean reversion over the next 3 to 5 months, I mean, those things are going to be coming way back. Um, okay. So hopefully this video was somewhat useful. Like usual, I had an amount of time in my head that I wanted to stick with, and I went way over it. So great. Hope you guys enjoy me rambling on. I'm not going to get into any of that. That's not worth it. All right, guys. Have a good one.